Howdy, Jacob here. Today we're looking at company Albany International in the machinery industry, 2.7 billion market cap on 3 billion enterprise value. They engage in the machine clothing and engineered composite businesses. Their growth has been fairly small. You're probably looking at low single digit growth over the last 10 years with gross margin a little bit lower than what it was 10 years ago, but operating margin a little bit higher. So they are producing a bit more earnings than they are revenue. Dividend increased pretty consistently, just 1 year where they haven't increased it. Return on invested capital is upper single digits, so maybe the last 5 years you're averaging about 8.5, 9%. So not terrible, possibly over their weighted average cost of capital, meaning that they might be increasing business, but um, for them to give money back through dividend does make sense with this low return on invested capital figure. Balance sheet shows 173 million cash on hand, with 453 million in long-term debt, 4 million short-term debt. Okay, so that 400 million is less than 4 years their 5-year average free cash flow. So not a big concern there, especially with they have as much cash on hand as they have. So really not concerned with that debt. Their use of cash is a little bit on acquisitions. They've had 3 years of pretty large net acquisitions. Their dividend of 31 million really only pays out about maybe a little bit less than 30% of their free cash flow, 1% yield. They paid down a little bit of the dividend. 2022, they bought back some shares. So they really do everything. They really do quite a bit with their free cash flow. A little bit of reinvestment in intangibles. So I think we're ready to start making some assumptions here. I would say on the revenue growth side, probably not going to be looking at anything too sexy. This might be a 3%, 14 on the P price to free cash flow. And for margins, what do we see up here? Okay, let's do 10, 9, share change. 27 million would be about 1%. 34 to offset stock-based compensation. I mean, maybe we'll say it just stays flat. They just do enough to offset stock-based compensation. And then the dividend, paying less than 31% payout ratio. I mean, they can increase that pretty substantially. Let's increase it slightly higher than their revenue growth. So by the end of 7 years, maybe you're looking at a 35, 40% payout ratio. Again, the company was incorporated in 1895, so it does make sense for me to be like, they don't have a lot of opportunities to reinvest. Best way to get money back to the shareholders, if you can't do that, is through dividend or share repurchases. And they haven't really historically done share buybacks, at least consistently. So to increase that dividend, I feel pretty comfortable with that assumption. And then we get to a price that needs to fall quite a bit before we get to a buy. But, interesting enough company. To me, makes sense. 24 PE down to a 14 PE with very little growth. Yeah, we're expecting it to fall quite a bit, or not expecting it. It's going to do whatever it does, but I won't be looking at it further until it drops a bit more. So I do hope you enjoy the video. Have a great rest of your day. Thank you.